This is episode 275 of the Andrew Hines Real Estate Investing Podcast. Welcome back to the show. Today I have Ian Armour on, and Ian is a guy talking about a topic that you have heard about on the show before. He's talking about Cleveland investing. And so Ian is from the east coast of Canada, and he decided with a previous guest of mine, Manny Schifferah, that they were going to invest in the US and they were going to invest in Cleveland. They're also partnered in with another previous guest of mine, that's Thomas Larini, who's a guy that I just love talking to, very much a wealth of knowledge. So the three of these guys have put their heads together and they're doing some pretty amazing things with some pretty amazing cash flow. And that's what we were talking about today, how to pick the market, what they do within that market, where they're willing to expand, how they stay out of trouble, being that it is Cleveland. And of course, it's not the sexy town, but it certainly is sexy from the standpoint of cash flow. And we definitely got into that today in some of the metrics that Ian looks for. So just before we jump into the show, kindly please, if you have not already done so, take a moment and rate and review this show. 5 stars would be greatly appreciated wherever you listen or watch. And then, of course, if you're a YouTube viewer, it would be greatly appreciated if you show the channel some love. So let's jump into the episode with Ian Armour. Please enjoy. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I have Ian Armour on the show. Armour, right?
Armour.
Yeah.
Yeah, like knight in shining.
Yeah, knight in shining. I'm sure you use that as a pickup line.
Yeah.
All right, Ian. Well, thank you for coming on the show. I know that you mentioned that we connected on Instagram briefly and you got yourself booked in. So I'm looking forward to hearing all about your story. Do you mind just sharing a little bit, high level, what, how you got into real estate and what brings you to sitting on this interview?
Yeah, so absolutely. So my story is not a unique story. I read Rich Dad, Poor Dad a number of years ago, and that just got me completely hooked on the whole real estate investing side of things. I knew that would be the vehicle that I had wanted. So to get myself in position to actually get into the real estate market, I actually started a roofing company, which I still own, operate today. That simply put, is something that I've transitioned out of, and I still own, meet with the guys probably once a week. And then that company's pretty self-sufficient. From there, got into flipping homes, did probably about 10 of those, and had the realization one day that, yes, I was in real estate, I was investing, life was good, but I really wasn't working on building that passive income side of things. So from there, I really settled and focused on how I'm going to get into some more buy and holds. So started off doing some conversions, turning single families, putting secondary suites in the basement, that here in Halifax, that's where I'm from. And then moved on up to getting some more 8-unit buildings. So I bought 2 of those in Halifax and started to hit a wall again. It's very hard to scale here in Canada. As a lot of people here will know, just with the tenancy laws, the price of everything, the government stepping in every way that they can, and just trying to get tenants out, do turnovers. It just got really difficult. I was quite fortunate on my 8-unit buildings here in Halifax, but I just knew that scaling in Halifax it was going to be really challenging. So got my head together with a few of my buddies, and we decided, we should move down to the States and start buying there. So we did. We decided first, let's see where some of the best areas are. Eventually found our way to Cleveland, Ohio, and we actually purchased our first purchase was a 24-unit, and then we bought 2 more 38 units after that, and now we currently have a 97-unit building under contract, and we're just going through the due diligence on that.
Yeah, so I think one of your business partners has already been on the show, if I'm not mistaken.
Yeah, Manny.
What's Manny's last name again?
Sheriff.
Yeah. Okay. Yeah. So Manny shared quite a few details. I'm assuming you've listened to that episode already.
Yeah.
Why don't you give like a high level recap? Because not everybody will have listened to Manny's episode. Can you give like a high level recap of what what you've bought so far? I know you did just give that, but updates since Manny was on as well.
Yeah, absolutely. So I guess high level, why we first picked Cleveland or picked Ohio in general. So one of the key metrics, outside of all the other metrics that you hear thrown around there, but for us was gross rent multiplier. So basically the ratio of your rents to the price, the purchase price. And we just found something that you were still getting high rents and you weren't paying millions of dollars over asking. So we decided that run the numbers, and that's what we determined was a good city. All the other major metrics that you'd consider in scaling a business were there too. Population, although it's not booming, it's very stable. So that was a huge reason why we chose Cleveland. Then there was just a number of other benefits that we found when we were there. So on a number of our current buildings there, we dialed into the CMHA programs, which is like their Section 8. So we were originally anticipating, we bought the units, rents were $650, $700. We were hoping that we could get them up to around the $1,100 mark. But through the CMHA program, we're getting $1,500 easily on a lot of our units. So we're getting a huge boost there. So that was great. We're just finding that, not having the government step in and saying, just being on the tenant side for everything has been just a breath of fresh air. So we, say someone's a month-to-month lease, you would just have to give them the 30 days notice, 60 days notice at worst. And if they don't pay or they don't want to leave, then the system's set up to actually help you move out tenants, move in higher paying tenants, and go from there. The other huge thing, we've developed a very strong boots on the ground presence there. So the property managers, we interviewed a number of different property managers, and the people that we found were investors themselves. So they own 400 units, and then they manage a couple of hundred of other people's. So we wanted people that were experienced and knew what our vision for the project was. So we met with them, and we just jump on calls weekly with them. We shoot emails throughout the week, but they do a lot of the heavy lifting, and we're really seeing things turn around. Another huge thing is, since Manny would have been on, we actually went back to Cleveland, and to see the amount of development that's going on in that area, it's crazy. Like right by our building, since when we first bought it and visited, a lot of more rundown buildings or vacant lots are not so much happening. But now when we go there, there's huge developments going up. There's a lot of construction in the city, and a lot of it's focused around the multifamily space. So it's just great to see that, the whole city's blossoming, and we're a part of it. And we've got some things that we bought that we've already put a lot of work into, and we're seeing that other people are also going in and doing quite a bit of work.
It's funny. I joked with you off camera here that interviewing podcast hosts, I don't really have to say much. That's held true so far in this episode. That's great.
Yeah, absolutely.
Okay, so also tongue in cheek. It's not often I hear people say we looked for the good areas and stumbled on Cleveland, but I totally get what you mean. You talked about a rent multiplier, or you're kind of referring to what we refer to as the 1% rule here, which no longer really ever happens. So what are you getting there? Like, give me an example. You could do it as a building, or you're paying a certain price per door and you're getting a rent of X.
Yeah. So typically when we're buying down there, for most of the purchases we've made, we're right around $50,000 a door, and we're getting ranging from 700 to say 900 in those buildings. The new 97 unit that we have under contract, we've got it just over 40,000 a door, so it's about 41,000 a door. And the current rents, they range from say 650, 700 for some of the tenants that have been there a long time to up to about 1,100. So, and that building it's right downtown. It's a 2-minute walk from the university. It's about a 10-minute, 15-minute walk to like the downtown core. You're like a 10-minute drive to the Cleveland Browns Stadium. So there's definitely a lot, a lot of upward benefit to that building. We toured some of the other buildings that have recently sold. They're selling for closer to 100 a unit, and their rents are 1,200, 1,300, somewhere in around that range.
So you guys think you're going to get there?
Yeah, eventually. These are slightly smaller units. We're targeting around 1,100, for which we're already seeing in the building, 1,100 to 1,200, and we basically, the plan there is to buy, do all of our renovations and refinance, pull out a lot of the capital that went into the building, repay our investors, and hold on to the building for a little while.
Yeah, and we're going to segue into talking about the investor structure and all that, but just I don't want to graze over it. So if you're 800 a door on average on 50,000 per door acquisition, that's 1.6%. So your rents are 1.6% of your acquisition price on a monthly basis. So that's way more than people in Canada are getting. Probably people in Canada are lucky to get a quarter of that, probably usually half. Yeah. Half at best. So that's sort of the ballpark that Canadians are in. And then if you're 42,000 a door, you said on the next one, then
somewhere around there. We're still going back and forth on the price a little bit, but for 97 units, we're about 4.1 as it stands, but we think that might come down a bit.
Okay. Yeah. So, I have it in here at 42,000. If you're 900 on average for rent, that's over 2%. Yeah. Which, I mean, when you're getting into that ballpark, even with the high interest rates, there's bonkers cash flow, which when Manny came on, that was what we discovered. So there are quite a few hands in the cookie jar with this one, so to speak, because you guys have got several partners, plus you have your equity partners that have come in with the cash. Can you tell me a little bit about the structure, how you guys have set it all up, and what the typical deal looks like?
Yeah, absolutely. So we're following a similar model to how we structured our previous deals, and that's 50% to the capital partners, 50% to the active partners. We're doing, and again, we're just finalizing this with our cross-border accountants, all that stuff. But we think we're going to have a GPLP structure that's Canadian, a GPLP structure that is American, and we might even have another corporation that actually owns the asset, just to set things up for tax efficiency, for limited liability, all that type of stuff. So then all the active partners that are on the deal, we've got about 5 of them now, and we just do our splits based on what everyone's doing. So some people are more focused on the capital raise, some people are more involved in the actual management of the deal, the construction, the property managers, all that stuff, and then our investors, they come in. So we buy the building, we don't do any cash flow distributions in the first year, but starting year 2, whatever we're at for cash flow, we split that out based on the equity that people own, and then at time of refinance, we pay back the capital partners. It'll be if things go really well with the deal, they'll get 100% back, and we'll have a bunch of money left over. If the deal goes a little bit slower, they might only get 80% or 70% of their originally invested capital into the deal, but they'll be splitting cash flow along the way. I guess the other thing to mention is, so we do it like you hear a bunch of different structures in the States where, the capital partners, they might get 60% of the deal, 70% of the deal, and there's pref shares and waterfall structures, all that stuff. We want to keep the deal simple. So we just said, you put up the money, you get your percent of equity, and then for us, no fees. The only fee that we have is the sales fee and a disposition fee, but throughout the life of the deal, we're all just split the cash flow, and we just keep it simple in that regard.
Yeah, simple can be nice. That's for sure.
Yeah.
So it's you, Manny, and you guys working with Thomas as well?
Yeah, exactly.
Is it just the three of you?
No, and then two other partners
on the active side, and then
yeah.
Okay, so as far as deals that you as a group have done, is this number 3?
So this one coming up is number 4, and we've actually switched up some partners from previous deals.
Gotcha. Okay, yeah, I was gonna say there's a level of sophistication to what you're doing, which people don't just do, like, go out and invent the wheel like I would try and do typically. They'll actually, shadow somebody who's already done it. I think Thomas is probably that guy for you and Manny. Would that be fair to say?
Yeah, so even before that, so again, over the last few years, I've both Manny and myself, we both bought properties here in Halifax on a smaller scale. So yeah, I've got about 20 units in Halifax, and Manny, he's actually sold most of his just to continue to put money down in the States. So we all had a bit of a background. Same with Thomas, like he's done a lot of real estate investing, but none of us had really done it where, we're trying to buy, even 30, 40 units, let alone like a 97 unit building. So yeah, that's where we're all learning some stuff together, but we all have a decent background in it.
Oh, for sure. And I didn't mean to imply that I was discounting that in any way. Just the whole doing things with GPLP, with the raises like that. Had you already done some structures like that in Canada?
No, more so, I've done them, but more like, more JVs where it's like one investor will come in and fund deals. Yeah. Whereas this one, we might have, on some of our deals, we'll have as many as 9 investors, or maybe it's just one that brings all the money. So for this one, it'll probably be a handful of investors that come in and fund the deal.
Yeah, that's a great segue into a very important question is, what's a handful in there? Like on your 90, you said you're around 4 million, and you guys are going to have to come in with what on that? Like $1.5 million, or are you going to be even more than that? More like 2?
We're shooting. So we could do it. So that's I guess just another really interesting point on the States is just the lending that they have down available there is just crazy. Some of it, they're set up for people to come in and grow, whereas it's just so hard in Canada. But some of our early debt quotes, and we've dialed these in a little bit further, is they would do 75% loan to cost. So 5% at it, and then they could do up to 100% of your capex. So for our case in this building, we've got our budget a little over $2 million for turning all the units. We got to do a new roof and fix up some of the masonry work, that type of thing. So some bigger ticket items, and our lenders, they said, give us your budget, your renovation budget, and we'll see if we can't get that fully funded. So we could basically do this whole deal with about $1.5 million out of pocket, but the costs do add up, and we don't want to be too over leveraged. So we're shooting for closer to about $2.5 million. Yes, it dilutes the equity a little bit, but it's just more safe, and that's we want to do this deal with a little less risk.
Yeah, I think that's a wise move for me. I don't like the gun to the head of being restricted on amount of available cash in a deal. So it's better to just have an abundant amount and be able to to make decisions that are best for the business, best for that
Absolutely.
building, and take it in the direction you need it to go. So I would do the same. And we're actually doing something similar with our camp and resort right now. Is we want to be in a position where we can do all the great ideas we have and not be restricted by the available cash for that. So you don't need to convince me on why the U.S. is a great place, especially when the politicians here in Canada are doing everything they can to tell every smart, sophisticated, wealthy Canadian to leave.
Yep.
So that's happening a lot. Do you find this is an easy sell? And just kind of witnessing some of the way you're talking, it seems like you have your shtick here when you're talking to your investors here. Hey, like, you don't have to look too hard to see how it is in Canada. It'd probably be a good idea to get some money out. Do you find that that's the approach, or tell me your spiel?
Yeah, absolutely. So yeah, it's huge to selling I guess the first hurdle people have to get over is, this is in a different country, it's far away. How do we know things are going to go well? Yada, yada, yada. It's like, well, you can look at that hurdle, and we've bridged that hurdle and shown that we can successfully do this. We have a track record of doing it. We're hitting above our target rents and all that good stuff. But it's like, that's one barrier, but look at investing in Canada, how many barriers you have. You've got, like I've mentioned before, like the government's in every way trying to discourage you from trying to grow, build a portfolio, all that type of stuff. The way the tenancy laws are set up, like for us, like we've already turned over, I'd say at least, 25% to 40-50% of our units, of our 100 units that we bought less than a year ago. And to get there, to do that in Canada would have just been a nightmare just from that side alone. But then also showing that, look, there's other buildings that are a block away from this that are worth what we're trying to do. So we're not trying to promise over the moon for what the value is going to be. It's just follow the process and away we go. And the other huge thing is, like, when we look at evaluating a building here in Canada, when you do the income approach, so it's just your net operating income versus your cap rate, you come to a number, and then you pretty much, on anything in Canada, you figure out where you could bring that building to once you do all the renovations, once you get all the rents up, and that's the price they're asking for. Whereas down in the States, or down in Cleveland, where we have these deals, that building, when we did the income approaches trying to determine what our asking price was, it was bang on. Like, it's like they are actually playing the game the way that it should be played, whereas up here everything's just overinflated, and it's just it's so hard to scale up here. So just handle those objections. They get to meet our property management team, which they're pros down there. They have the whole systems all set up, the communication, the monthly reports, the pictures of before and afters, and all that good stuff. So it's just trying to bridge that gap, and that's how we've been doing that.
Yeah, I don't think it would be a hard sell, especially if you're doing it, you believe in it. They say the hardest sale is selling yourself. If you're sold on it, it's very easy to convince somebody else. This is obviously going to be a good move. I mean, Cleveland, the skepticism I think some would have about Cleveland is, and this is coming actually from information from a previous podcast guest, is just cities like Cleveland in recessions, sometimes their population shrinks. And I don't know to what degree. I think you guys have such a padding, it's probably not even of concern. But do you get those kind of objections about Cleveland?
Not so much, really. So again, we're not selling it on this is a boom town and there's people moving to it left, right, and center. We're just saying it's stable, and it is. Like their population isn't growing like crazy, but it's not shrinking like crazy. It's been pretty much stable for the last few years. They've got a lot of big companies there that are keeping people around, and then that's for like this building here. But on our other ones, they have where we're purposely going after some of the Section 8, the CMHA. They have a waiting list of about 1,500 people that the government's willing to pay their rent as long as your unit meets a certain standard. So from that side of it, we're very content there. And then on this new building, again, we're a 2-minute walk to a university. We're right downtown, so it's not like your normal market conditions that are necessarily steering our decision here. It's more of what's very close to these assets or what sort of tenant profile you can get in there.
Yeah, I've loved the sounds of Cleveland ever since Thomas talked about it the first time he came on.
Yeah.
What do you what do you do to find a building there? Is it all on market stuff, or are you guys going after off market?
Yeah, so now that we've bought a number of buildings, we've played nice with all the lenders, all the individuals involved. So now the actual brokers are bringing deals to us, which is nice. So on this deal, we got a call before it was listed, anything like that. We booked flights for 2 weeks later. We were down touring the building and got it under contract before many people could bid on it. So that's how this one came to be. Our other ones were mostly on market. Like it's that just like the multifamily down there is just not as competitive as it is up here in Canada. So you have a lot of building owners that are just not trying to maximize portfolios, that aren't trying to make a deal happen out of nothing. It's like they're available. So yeah, it's not hard to find a cash flowing multifamily building on market down there.
Yeah, that's amazing. I mean, I have looked, and it doesn't just jump off the page at me, but it's probably just when I looked. You guys are probably checking every single day, looking at what's available. What's your criteria? Is it just as long as you can get it 50,000 a unit or less, you're interested, or is there something more?
No, it's that's the first thing, to at least get it into our processing or our analyzing it. But once we have a deal that we've collected, that's what we look at it like we look at deals in Canada. We see, where is it currently? Where could we get it to? Can we do a perfect BRRRR? Are we going to hit the cash flow? Are we going to not have to do any crazy repairs, like there's no foundation issues, that type of stuff? So we want things that aren't a crazy amount of work, but we want things that can certainly hit our target rents, and we want them in areas that are close to things that are going to sustain that. So one of our first buildings right by the Cleveland Clinic, it'd be maybe a 5-minute drive there, and that the Cleveland Clinic alone, it has its own postal code, it has its own police force. It's these are areas that are going crazy, and that's the exact area I said there's just development going on left, right, and center there. So area location's definitely huge for us, and then just passing all of our financial checks.
Yeah, so it sounds like you've got your buy box fairly well laid out. What would, is there a cash on cash return that you guys try to model out that you're looking for, or is it or a prior indicator that would indicate you're going to get your desired cash flow?
Yeah, so I think for us, and each deal is a little bit different depending on how much work needs to go into it, how risky it is, all that good stuff. We want to shoot for around when you look at after the equities returned, all that stuff. So that's always a metric we struggle with, because if we're doing a BRRRR, then once you get your money back, it's just an infinite cash on cash return. So it's a nice selling point when we say that. But in the first few, it's hard to put a number on it like that. We try and average, once you get your equity back, you look at the equity in the deal, you look at your cash flow, you want to be around a 20% return
on the original invested amount.
Yeah, annualized,
even though they already got it back.
Yeah, and then we want to keep that going forward. But then again, that's where it gets kind of convoluted, because once you have all your money back, then you're still getting a return after that. So it's
tough to even present that. It's just really awesome. See, can't even calculate a return.
Yeah, exactly.
Yeah, those are great ones to sell, and probably get a lot of enthusiasm. I've noticed there's just a ton of enthusiasm in general for people in the investor community in Canada that they're so tired of all this, like you've kind of pointed out. Like there are some that just still want to invest in Canada, and that's great. Actually, that's probably still the majority, but there's like this growing segment that's just ready to look elsewhere. And
absolutely,
Cleveland's close enough. Like, man, if you had a boat, you could just drive across from
exactly.
Lake Erie. It's not like it's far away. Ohio is known in general to be very landlord friendly, considered one of like a destination state for investors. So, I mean, that's super awesome. And then, like you've pointed out, Cleveland Clinic, I would want to be around that because that's not going anywhere. That's like big dollars that are in that. And that's a world-class institute, right? Or world-class hospital.
Yep.
So, I mean, yeah, that would give me a lot of comfort. And then, from the university standpoint, like how close is that to the rest or the Cleveland Clinic? Is that super far away, or they're all reasonably close together?
So it'd be about from the new 97 unit we're looking at from our first building, it's maybe 5-6 minute drive. And then the buildings, the Cleveland Clinic's maybe 3-4 minutes past that, 5 minutes most. So yeah, you're call it 10-15 minutes away.
Yeah. So everything's pretty well connected.
Yeah.
And I had a question for you. It just escaped me. Are you looking at any other cities, or is it Cleveland all the way? Like what's your plan there?
Yeah, currently Cleveland all the way. We want to just continue to scale there. I mean, we have the boots on the ground, like I said, and like a lot of this wouldn't be possible without having such a strong management team down there. So to roll the dice in another state that we're not as familiar with, it's not high on my list of things that I want to do, because like now we actually know, oh, this is a good deal in Cleveland. Yes, we can hit these target rents. Yes. I know that I have competent operators. So the plan for now is to continue to scale in Ohio. And then, once we hit a certain amount of units, or we're happy with that. I mean, like we get deals from Texas and North Carolina that are floated to us, but it's just not as appealing knowing that we would have to reset up the people, the market knowledge and all that good stuff. So very happy and content in Ohio.
That's the tough thing, going to any new area. And I was guilty of that, when I was so set up in London, just didn't want to look anywhere else because I knew that market. And it's such a pain to go to a new market. Like even if you guys go to a new city, you said stay in Ohio. What cities would you go to? Would you go to Akron, Columbus?
Yep, those are the two other ones that we would actually go to. So we've actually looked at deals in both. Columbus is actually that's a city that's definitely trending in the trending up. I know it recently, like I'm always reading best cities to live in the U.S. For an investor and all that good stuff. Columbus is actually thrown around there quite a bit. And then Akron, they've got, again, our property managers would support Akron. They have buildings there. They keep singing the praises there. Akron would definitely be one high on the list. Columbus a little further away, but it's definitely got some good stuff going on there as well. So
is Ashtabula, is that in Ohio or is that in New York? I'm trying to think of where that one is. I thought it was.
I'm not sure. Yeah,
I just remember doing the drive. I used to drive to Youngstown when I had some properties in there. I was looking at stuff, and I always remember seeing that city. Maybe I just drove through it. So you guys. Well, you've got Cincinnati as well. I guess that's really far. You're probably not.
Yeah, that one's, again, that's I might as well go to Texas and when it's that far. So
yeah. Hey, Youngstown's not too far. What do you guys think about that?
Haven't looked at any deals there.
No. I mean, I say that tongue in cheek. I think one of my most avid listeners is from just south of Youngstown and Boardman. I see it come up on my stats for like years now, which I think is hilarious. So that's awesome. Whoever that is, reach out to me. There are some nicer pockets around there. Youngstown, like in the heart of it, probably wouldn't be your first pick, but there's the suburbs of it could be cool. But that's awesome, man. Like, I mean, obviously Cleveland was to me one of the most obvious places you could go in America for cash flow. And it was just the obvious concerns of it's not the sexy town, but it does still have a lot going on from a market fundamentals standpoint.
Yep, absolutely. And again, just so many things working in your favor there. It's like they want you to grow there. Like it's
Yeah.
ripe for the picking right now. And I don't think it will be for too long because, yeah, all those lists coming out of like best places to invest for cash flow, best places like where you can buy cheap property and all that stuff. So I think more and more people are finding out about it. Yeah, it's nice to have a team there, be established, and then just keep doing what we're doing. We're not reinventing the wheel. We're just doing the same thing over and over and just getting on larger and larger buildings.
You were saying that getting on the Section 8 list, like how much of a difference did that make? Because I know you mentioned it, but I was kind of paying attention to everything else you were saying. How much of a difference? So are you going from a market rent of $900 to the $1,500 you mentioned?
Yeah, probably. So this one, don't just think every Section 8 is going to get you 1,500. So this building in particular is 3 bedrooms, and 3 bedrooms go for a larger premium. And now how they do it is it's based on zip code. So depending on where the property is located, they'll give you certain amounts. They also have other programs. Edna's another one, but the CMHA is the one we're having the most luck with. So it's once they're in, it's great, but they can be slow getting in there. So for us, because we're not like we have some reserves, we're continuously turning over units, all that stuff. Sometimes it can take maybe 2 months, 2.5 months to actually get the tenant in there. A lot of paperwork. Again, we chose property managers that are familiar with the process, have contacts that they can call and try and speed things along. But it's a bit of a process, but then once they're in, life's easy. So
yeah, I mean, I wonder about that though. Like, does your existing tenant base in those buildings, like, is there any sort of negative impact from the Section 8 tenant base? Because Section 8 is typically assisted, right? Like they're basically paying the rent for the tenants.
Yeah.
What type of demographic is it that's coming in that's getting rent paid for them?
Yeah, so definitely a mix. So a lot of like single parents will qualify for it, or people that are a little harder down on their luck or not having luck finding employment or whatever it might be. But from our experience so far, hasn't been a lot of issues. Not tenants complaining about each other to other units or anything like that. In fact, it was our worst tenants are the ones that we inherited. So we're actually, so we bought the building with a number of vacancies. So we filled those, put in CMHA tenants, and now we're working through the list of who's causing the most headaches, who's paying the least rent, who's causing it, not paying on time, those types of tenants. So then that's the next group of people that we're targeting throughout. So then at the end of it, hope to have as much as Section 8 in there as possible.
That's interesting. Yeah, I've heard people sing the praises of that program. Obviously the benefit is these tenants don't want to lose their spot. So what are some circumstances where they would no longer be able to be a tenant? Like, what are their requirements to do? Like, they can't damage the unit or cause problems? That's basically it.
So pretty much. We could send in reports saying that there being an issue, and then they would potentially lose their financing for their rent. So that's a huge one. They stay on us too, so we can actually increase the CMHA every year. Percents vary, but in the ballpark of 5 to say 7% per year. And the process with that is they just come do another inspection, and sometimes they'll fail the inspection on like stupid things like the towel rack is loose or something like that, but most of the time it's obvious stuff. So if a window's not opening, you got to go fix that up. So they put an onus on us to make sure that the units are well maintained, but it also they police the people that they're putting in there. So if they're causing issues, then they could lose their CMHA.
And who was the person in your group that had the connection to that? Like, how did you guys figure that out?
through our property managers. So we interviewed a number of property managers. Some, when we originally looked at the building, they were like, no, this isn't a good building. Then we have interviewed other property managers, and they were like, yeah, this is a great building, and we're used to the CMHA, the Section 8, all the different programs. You'll be able to get, 14, 1,500 for these. And we were blown away because we had our whole deal analyzed to get 1,100 for all the rents and turn the units over that way. So when they came with an extra 400 per unit per month, yeah, we were pretty floored by that.
Oh, that's awesome. Yeah, those are nice surprises to get.
Yeah, and again, if we had just listened to the first property manager, we might not even have bought the building. And now, that building's super strong. So,
man, I love it. That's amazing. How do you guys avoid picking a bad area, or is there such a thing in Cleveland? I know none of Cleveland's sexy, but is there areas you won't go?
Oh yeah. So we were kind of cautious on this once we got a little warmer to investing in Ohio, but East Cleveland, it's insane. So in your London, in GTA and Halifax, wherever, you have some rougher areas, and it's nice to know about those. But in Cleveland, it's absolutely insane. This East Cleveland, it looks like a war zone. There's boarded up buildings, there's uncut lawns, roofs caving in, all this stuff. And it's a little bit further outside the city, but we were originally looking at deals and being like, this is $7,000 per unit. Why don't we go buy this? And then came to the quick realization that is a really rough side of town. But yeah, it's crazy. Just one street over, you cross the highway and you have a little Italy down there, and it's flourishing. It's gorgeous. The buildings are nice. The real estate's expensive. It's crazy. So just one street over from this area is nice again. But yeah, East Cleveland, we won't even look at it. And then there's also these other areas that I forget the term. We don't buy them. So there's Cleveland Heights, or there's a number of different areas that basically the city has a lot more control over you. So if they can come up to you any day of the week, slap a notice on your door that says you need to get your roof replaced in the next 60 days. So point of sale. So that's the term. So they're point of sale properties. And if you invest in those areas, they have a lot more control over you. So we avoid any areas with any of those types of restrictions.
Interesting. Yeah, I looked up Cleveland Heights here, and I see University Heights is not far. East Cleveland versus University Heights. They don't look very far away.
Yeah,
a couple kilometers.
Yeah.
So it's all. What's the population of the city, the greater city?
City is it's kind of like GTA, where you have different areas. But the population of Cleveland, the actual downtown core, is 350,000, I think. But the greater areas, around 2 million. So same as you have some areas that just are. It depends on where you're trying to count it, but yeah.
Nice. Okay. And is there anything you would hope to cover on this interview that we haven't yet talked about?
I would say that's pretty much it. I guess one other interesting point with some of the lending, I meant to bring it up then, is some of the conditions they have when we're doing these types of loans. So we are doing it's a bridge loan essentially, and then we'll carry that over to a Fannie or a Freddie. So with this one, we're around the 9% interest mark, which even our broker said that they hadn't seen a single digit interest on a bridge loan in a few years. So we were pretty happy about that, even though rates are going up in the States again. So we have to lock this in by the end of the week essentially. to keep that rate. Otherwise, we might see 10.5, 11%. But yeah, so with that, they actually have some interesting clauses. A springing lockbox clause. I don't know if you ever heard or ever dealt with that. So basically, what happens is, if our debt yield, so debt yield is your ratio between your net operating income and the total loan. If that falls below a certain threshold, that will actually trigger the springing lockbox. And what happens then is all of your operating accounts will actually then get transferred to the lender, and the lender will actually work pretty much side by side with you to make sure that the right things are getting paid, the right direction of the project is being kept with every decision. They take over the property management side of it, and yeah, things get a little harder there. Now, for our debt yield to fall that low, like, we would have to lose a lot in the rents, and it's like, they understand that if there's some move outs because we want to do elevator maintenance or whatever it is, they understand that. But yeah, I thought that was a pretty cool provision that they had in there, and just not something I've seen here in Canada.
Yeah, I've never heard of that, but
yeah,
I guess it sort of makes sense. Although banks are not in the business of managing properties, so
no,
I imagine they'd want you guys doing it. I don't think they're going to be quick to jump on that one.
No,
there in case they really need it.
Exactly. Yeah. So
awesome.
Yeah, I found that was interesting too.
Okay, Ian, where do people find you and learn more?
Yeah, so first off, we have Manny and I, your previous guest, my partner. We have a podcast, Refined Real Estate. We talk a lot about our U.S. investing. We talk about stuff that's going on here in Canada. You can also find me on Instagram at Refined Real Estate NS, or Ian_Armour, and that's my personal account. And yeah, Ian_Armour. So yeah, happy to connect if anyone wants to talk more about investing in the States. Yeah, we're certainly open to that. And yeah, Andrew, thank you very much for having me on.
Yeah, thanks for doing this. It's great to learn about what you guys are doing a little bit more. And yeah, I do find the Cleveland discussion fascinating. So very good. And yeah, hope we can stay in touch.
Absolutely.
All right. Thanks again, Ian.
Thank you.